Okay, welcome to your second Foundations workshop. And this one, we're going to kind of give you a spin overview of all the different types of investments you have available to you within the market. So, kind of like before, I'm not going to necessarily do presentation mode here because I might use my little pencil tool. So, let's take a look. I'm going to do some definitions first. So, first of all, cost basis. Okay, this is something that you'll hear a lot. Okay, so cost basis, like a lot of industries, the finance industry likes to add its own vocabulary to make things as confusing as possible. So it seems like only they would understand what's happening. One of those is cost basis. So cost basis is literally just the cost, how much you paid for an investment when you take into account all factors. Now, most of the time, all factors just means the cost. Let's say you buy 100 shares of $100 stock. They're going to say, well, the cost basis is 100 times 100 shares, right? So, which is $10,000. And then they're going to say, well, there's commissions on top of that. But these days, commissions are so low, $7 from TD Ameritrade or $5 from Tastyworks. Honestly, in this course, when I talk about cost basis of buying stock, I'm going to go just for the stock price. If your capital is so limited, let's say you only have like $100 or $500, that you're going to be buying like one share of a stock. Most of the strategies in this course aren't going to work for you, to be perfectly honest. But what I would say to you is, if your capital is limited so much that $5 commission does affect you, I would recommend the brokerage Robinhood if you're not familiar. Robinhood is app based only. You can't use it on the computer. It's very limited, but it does allow you to buy stock for zero commission. So if you're in a situation where you can only buy like one share of stock right now, Robinhood is a great way to do that with no slippage in your cost basis. But my general recommendation is, if you only have, say, $100, save money. Like, if you can get up to $2,500 in your account, that's a really good starting point, and it'll allow you to do most of the strategies we're looking at in this course. So, but that's kind of for another day. So cost basis, simply just the cost of a particular, cost of a stock, whatever, however you purchase it. Okay, max profit. And I should say gain. Let's fix that. So max profit, the maximum amount of money you can gain on an investment. Now, depending on how much time you spend on module one, you might think, well, you buy a stock can go up forever, right? So maximum amount of money you can gain on investment should always be infinite. There should be no cap. Well, that's not true at all. In fact, most of the strategies we'll do in this course have a maximum profit associated with them. That at first glance seems crazy. You're like, why would you do that? Well, the reason you would do that is it affects your probability of profit. By giving up some of our gains, we're increasing the chance that we're going to make money. And that'll come into play much more as the course goes on. So max profit, amount of money that you can make on an investment. Max loss, just conversely, the amount of money you can lose on an investment, right? So again, if you buy 100 shares of $100 stock, your max loss would be that company going out of business. $10,000 would be a max loss. Pretty straightforward, that one. And then break even. Now, this is actually one we're going to focus on a lot, and you'll hear me say this over and over again from now on. Simply put, your break even is the price of the stock hits when you start losing money. Now, if you think about a simple stock purchase, you buy that 100 shares, you've got that $100 stock, and you buy 100 shares of it, right? So you got a $10,000 investment. Basically, that your break even is the stock being at $100. The second the stock goes down to $99, you start losing money. The second the stock goes down to $99.99, you start making money. You start losing money, excuse me. So on a standard stock purchase, your break even is essentially the price you paid. Technically, it's the price you paid plus commission. But again, commissions are so low. If you imagine you buy that stock, you spend $10,005, and the stock is currently at $100. technically, in order for you to make money at all, the stock needs to go up, right? It needs to go up to what, 150? No, 105 cents, right? Because you're going to have 100 shares. So it needs to go up to $100.5 before you actually start making money. So technically, if you do factor in commissions, the second you buy a stock, you're already below your break even, right? Because of your commissions. But again, commissions are so low these days. As we see in Robinhood, they're free. I'm not even going to factor that in. Okay, buying power reduction. Now, again, this will come into play a lot more. But if we think about that 100 shares of $100 stock, it's $10,000. The buying power reduction is how much money the brokerage essentially holds up in your account when you do that particular investment. Now, at first glance, it might seem pretty obvious what that is. You say, well, I bought 100 shares of $100 stock. The brokerage is going to take $10,000 out of my account. Duh, what else would it be? Well, that's not necessarily the case. If, for example, we'll look at different types of accounts in a later module, but in a margin account, they're only going to hold about 1/3 of the value of that stock. So it's pretty interesting. That'll come into play a lot later, especially when you're looking at options contracts, and especially when you're selling options contracts. Buying power reduction is going to be an important thing. So we'll talk about that. It's going to help you manage your risk, your overall risk in your portfolio. And I keep getting these little pop-ups here, so let me just put my little snooze on here. I don't need all this junk coming up. There we go. All right. Okay. So just think on those for a little bit. Cost basis, cost of a particular investment, max profit, how much money you can make, max loss, how much money you can lose, break even, the point at which you start losing money, and then buying power reduction, how much the brokerage holds. So those are some important definitions that will come into play as we move along. All right. I'm going to spin through these fairly quickly again. As always, if you have questions, let me know. But let's look at the three main items we're going to look at in this course. Number one, stock. So stock is simply just part ownership, and the financial term would be equity in a company, right? A company makes itself publicly listed in order to raise capital. Many companies, whether they're publicly listed on the stock market or not, they have shareholders, right? They have people that own parts of the company. Publicly listed company just lets anybody, the public, own a segment of the company. So stock is literally part ownership. They're generally considered, sort of two types of companies, growth companies and dividend companies. So a growth company is essentially a company that is still building and still innovating. There are some companies, for example, Amazon, that are like permanently growth companies. Like Amazon is always putting all of its earnings back into innovation. So it's like a permanent growth company. Whereas something like, say, I don't know, like an IBM or a Lockheed Martin or something like that, probably more like a Lockheed Martin would be a good example. They've sort of done their innovation to a greater extent, right? They have a business model, they follow it, and they make money off it. And the basic difference is that companies that are in these kind of growth periods, growth companies, don't tend to pay out dividends because they're putting the money back into the innovation within the company. Companies that are through these growth periods do tend to pay dividends, but they move more slowly. So in this course, we're not really going to be looking at a dividend paying stock as a benefit because we want stocks where their prices move, volatile stocks. And when it comes to dividend-based stocks, they're not usually volatile stocks. There are some exceptions to that rule, though, and they'll come up as we move along. And then stock is really easy to understand. Stock goes up, you make money. Stock goes down, you lose money. Simple as that. And let's just quick skim through these items. Now, all of these items, cost basis, max loss, you're going to hear me repeat them ad infinitum, so I'm not going to go through these in real detail for each one. I'm going to kind of skim through them. So cost basis on a stock is simply the price you paid plus commission. Like I said in this course, I'm going to ignore commission, okay? Your break even is your cost basis. Your max loss is your cost basis. So whatever you pay for the stock, that's where your break even is. That's how much you can lose. Your max profit is unlimited. Technically, a stock can go to infinity. Your buying power reduction in a tax sheltered account is just going to equal your cost basis. In a margin account, it's going to be about a third of your cost basis. And we'll come back to these later. Just for right now, in the back of your mind, realize that there are certain types of account that do not require you to put up the entire amount of the stock purchase. All right, let's look at futures contracts. Futures contracts are very similar in movement and feel to a stock. They're essentially a binary instrument. They go up, they go down. But there are some nuances to them. We're only going to cover futures a little bit in this course, okay? They kind of sit between stock and options. So you see, it is a contract between two parties. Price is derived from the price of an underlying asset. So essentially, if I'm going to buy, say, a gold future, when I'm looking to take a position in the gold market, when I buy a future, it's going to have an expiration date on it. So I'm going to be looking and saying, okay, I'm expecting gold to move up or move down by a certain date, as opposed to if I were to buy, stock in a gold ETF or something like that, which we'll look at too, where you just like, I just think it's going to go up, over, a long period of time. Futures contracts have a date when they expire. They are generally considered to be speculative, which means that people that are part of the futures market usually have some sort of assumption on the direction in which way something is going to go. And they want to essentially make a bet, make a play on that. And futures do, in a lot of cases, represent and can cause delivery of specific assets. Literally gold bars. If you buy a gold future and you choose to exercise that future, they will literally bring gold to your door, like physical gold, physical pigs, physical corn. This literally, it essentially never happens. The brokerage firm will not allow this to happen, okay? But it can technically happen if you ever wanted it to. So if you wanted to get a bunch of tankers of oil, you could do that using a futures contract. People use futures predominantly for leverage. We'll talk about leverage a little bit later, but leverage essentially lets you get into an asset without using a lot of money, okay? And just like stock, if a future goes up in price, you make money. If a future goes down in price, you lose money. So with that in mind, your cost basis and so forth on a future is very similar to a stock. It's going to be your price plus commission is your cost basis, your break even is your cost basis, your max loss is your cost basis, your max profit when you buy a futures contract is unlimited. This should say buying a future. Let me just change that. Buying a future. There we go. And the buying power reduction, this is crazy. It's only 5% of your cost basis. That's why people use it for leverage. If you buy, say, an SP 500 futures contract, the actual value of that contract is a little over $100,000, about $115,000 right now. But they're only going to hold up about $5,500 in your account. So people can get access to giant markets without using a lot of money. That's what's called leverage. We'll talk about the pluses and minuses of that a little bit later in the course. So stock and futures, very similar in the way that they move. Futures are just much larger generally than stocks to begin with. They often represent commodities, and commodities are physical things like gold and oil and things like that. And they have a significant amount of leverage. And then option contracts, we looked at this a little bit in Module 1, but we'll just kind of quickly repeat some of those pieces. It's a contract between two parties, always two parties involved. The price of it is derived from the price of a particular underlying asset, like a stock. Options, generally speaking, are speculative too. This is where people are going to put a guess on where they think a stock is going to go. And people use them for a lot of things. For hedging, you'll hear the word hedging. Hedging is essentially protecting yourself. You can get good leverage with options as well. And they're very mathematically oriented. So we're going to use them more to quantify the expected movement of a stock. Might seem a little crazy right now, but believe me, it'll become second nature by the end of the course. And then there's a lot of literal options when it comes to options. There are lots of different ways to make money. Movements in the price of a stock, changes in the implied volatility or the fear rating of a stock, simple idea of time passing. Now, when it comes to things like cost basis, it depends on whether you're buying or selling an option contract. So if you're buying a contract, it's very much like stock. It's price plus commission. Your max loss is your cost basis. Your max profit is unlimited. And your buying power reduction is your cost basis. This one, the break even, it's the strike price plus the cost basis. Just kind of skip that one for now. We'll come back a little bit later and we'll show you exactly what that means. So that's buying an option contract, but we looked in Module 1 at selling an option contract. This is where we're going to spend most of our time. And the reason that we're going to look at it, and we'll dig into this more, is that you've got more than one way to be right. It's not just about direction. It gives you a way to actually reduce your cost basis. You can buy 100 shares of that $100 stock for less if you sell options as well as buy that stock. You can quantify your probability of success. When you buy a stock, you really don't know what's going to happen. It's basically a 50-50 shot. It might go up, it might go down. When you sell options, you can actually quantify. You can say there's a 70% chance I'll make money on this investment. You can choose your max profits and your max losses when you sell options, which is kind of cool. You know, you buy that stock, it's kind of limited to the losing on the stock. You can choose when you're an option. I want to make $100 and I'm willing to lose $100, or I want to make $30, I'm willing to lose $100. You can make all those adjustments, and it's all comes into one big mathematical formula, which we'll go into. And you can be what's called a contrarian. This is one of the hardest things to do, but this is essentially saying, I want to take the other side. If somebody thinks a stock's going to go up, I'm going to bet on it going down. If the market as a whole thinks that the market's going to keep going up, I'm going to take the opposite side. I think it's going to go down. That's being a contrarian. And there are lots of reasons why there's benefits to that. You'll see themes throughout the course again and again. So again, I know this is quick, but just kind of getting you introduced, getting everybody on the same page. So, ruminations. Welcome to the ruminations portion. Just thinking about that futures contract that I talked to you about. If you wanted to buy into the SP 500 market and you were an investor with a decent amount of coin in your pocket, you could buy what's called an E-mini future for SP 500. Its value is about $100,000. It's a little bit over that right now, but that work for this particular example. When you buy one of those contracts, let's say you have $100,000 in your account, and you buy one of those SP 500 contracts because you think that the SP 500 is going to go up in value. The brokerage will not actually take $100,000 out of your account. They'll take $5,000 out of your account at the inception of the contract. Now that may change as time goes by, but for this particular question, we'll keep it simple like that. Here's your rumination. What type of effects do you think that could have on an investor? They're buying into a $100,000 investment, but the brokerage is only holding up $5,000. Just in the back of your mind, if you want, you can post a Facebook group. It's your choice. What do you think about that? Are there any pluses, minuses? Do you have any general comments about the fact that you're only going to be held up about 5% of the value of that contract? Okay, so ruminate on that, and I'll see you in another video.